All right, and we should be live. Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you here for another monthly Macro Maven marvelous update from the Macro Maven herself, Stephanie Pomboy. Hey, Steph, how you doing?
I'm great, Adam. How are you?
Good. Happy New Year. Hope you had a wonderful holiday.
I sure did, although it seems like forever ago at this point. The first 2 weeks of the year feel like a decade already. So
I know. Well, we titled this "Get Ready for a Wild Ride in 2026." If the first 2 weeks of the year are any example of that, I think we're spot on there.
Yeah.
Did Wilhelmina did Santa leave some good snacks for her under the tree this year?
I mean, every day is Christmas for her, as I'm sure it's the same for Boston and Bodega. They probably are equally spoiled, I have to imagine.
They had a good time. We kind of spoiled them more with hikes and whatnot. They have loved it. Their labs, it's a breed that was bred in the cold, Newfoundland north, but they'd never seen snow before, and it has like unlocked something in them. They just can't get enough of it. They love it. So
anyways, that's awesome. Good.
They're doing well. Speaking of Wilhelmina, though, I think I hear her gently snoring there in the background.
The soothing sounds of Bulldog.
Yes. Well, I'm glad she joined us here today. All right. Well, look, there's an awful lot to talk about. I also polled our audiences on X to see if they had questions. I got a ton. So I'm going to ask my questions. I'm going to ask some of theirs. If there's time left over, we'll open it up to folks watching here in the live chat. But most important topic to start with, Steph, is that your and Grant Williams's Super Happy Terrific Day conference is just a month away.
It's fast approaching. I know. I can't believe it. It feels like when we started planning this, that it was like forever down the road, and then I blink and all of a sudden it's here, and I'm so excited. I know I mentioned this last time that you're going to join us for that, because I think that just adds such a fun element to the whole proceedings. So super excited to have you, and we've got a great lineup, including people that you often have here on your program. So it'll be a great opportunity to mix it up with people like yourself and Grant and me and the people at Copernic, as well as Tom McClellan and Tom Hennig.
Mike Green too.
Yeah. So yeah, it's going to be it's an interesting and diverse cast of characters. And like you said, given how this year has started, the timing could be
better.
Fortuitous.
Yeah, it could definitely not be more timely. All right. So for folks that would like to attend or at least learn about the event, where should they go?
Yeah. Well, I will post this on my Twitter. I have posted it, and I'll pin it on my Twitter feed at @spomboy, a link to register, or you could go to macromavens.com and inquire there. But let me post it. It's probably best for me to just post it on the Twitter. And there's a registration link, and it is immediately after President's Weekend. So it's February, February 17th and 18th in sunny South Florida in St. Petersburg, which is just a really cute town. And it's a beautiful hotel that we do the venue at, an old historic hotel. So great opportunity to get out of the cold weather for a little bit.
Yeah, I can't wait to go for the fun and the people, but also, to get out of the cold that we're having here and go spend some time there. So folks, if you want to join us for fun in the sun with Steph and Grant and the A-listers that they've assembled for this event, please come join us. All right, Steph, well, look, the topic that is on everybody's mind this morning, especially in regards to you, who's been such a champion for the precious metals, is...
now what?
Now what? I mean, we're in a clear melt up, at least for silver, for sure. But both gold and silver, as of this morning, hit all-time highs yet again. Silver futures were at one point, at least, above $92 an ounce. I can't believe those words are leaving my mouth. Yeah. The Shanghai price is $10 or more above that. Wow. So it's already triple-digit silver in dollar terms over in China. So I guess my main question to you is just, what's your response to what's going on right now? And then I've got a whole bunch of follow-up questions like, okay, so when do you start determining when it's time to sell and da 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 da.
Yeah, no, I saw the response to your Twitter question to people, and there were a lot of questions about when to get out, and so that's definitely a timely and interesting topic. And I will confess that I think, like you, the move has unfolded much more rapidly than I expected. I mean, I did expect, and I still expect, to see gold, north of $6,000, in the not so distant future. But the speed with which we've gotten there has taken me by surprise.
So sorry to interject, but I was trying to explain this to my wife the other night. I'm like, she knows that we bought precious metals a long, long time ago. And I'm like, they've done exactly what I thought they were going to do price-wise. In terms of getting to the prices that I bought them because I thought they were going to get to, they just decided to wait a whole bunch of years to do nothing, right. and then make it all up in a year.
Yep. Oh my God. Yeah, it really has been an emotional roller coaster because for that long stretch of time, we were basically like, oh my God, is this ever? All of the pieces were falling into place. But the metals weren't really responding, and especially not the miners. That was the thing you started to see, like in gold, for example, prices move up and the miners were just dead money. And then all of a sudden the catch up has been spectacular and a little unnerving, frankly, because of the speed with which it's happened. And I do joke sometimes with people, like, maybe part of the reason why we find it unnerving is just that we've been so bruised and bloodied after sitting hunkered in the trenches for so long, that this just feels like an out-of-body experience. And, you never think of the metals or the miners as meme stock equivalents. You don't never imagine yourself in that kind of feeling like, oh my God, this is just a massive move and I'm making, all kinds of money in these crazy things. And here we are. And it's scary because it does have those similarities to what we were seeing with some of those meme stocks. But the difference, obviously, is that the fundamental arguments are
right. Well, and it does look. I mean, the price action now looks not only similar, it looks even more extreme than the previous two. Maybe not the 1981, but the previous two peaks that we've seen in the metals markets, which were then followed by dramatic crashes and then dead money for a decade. So there are a lot of people who are worried that is this just the third iteration of that?
Yeah, and I mean, I'm loath to use the phrase that it's different this time, but there are fundamental reasons why gold has moved this quickly. Mm-hmm. And I think a lot of them obviously are related to what we're seeing coming out of, first off, there are things that are related to the last, decade plus of excesses that we built up. That we have kind of here in the West blithely ignored. I'm talking about our fiscal situation, and we've kind of just assumed that we could continue to borrow as long as we wanted. And meanwhile, we knew that our foreign creditors were starting to diversify away from dollars. And yet no one was hitting the alarm bells because it just seemed like it was so glacial and none of it was really going to add up to anything material. And frankly, as many times as people like me and you were warning that this is eventually going to reach a point where there's going to be a come to Jesus moment, it never seemed to happen. So, the deficits kept getting bigger and bigger and foreigners kept diversifying more and more away, and it never had any impact. And now I think those trends have hit warp speed. So they've gone from sort of glacial moves in the background into overdrive. And that's in part, started, of course, with the weaponization of reserves, weaponization of the dollar when we froze reserves after the invasion of the Ukraine. But also, when Trump came in and started this tariff diplomacy and basically using that as a tool for not just, I know the purported goal is to, right our trade imbalance, but it appears like it's much more about moves on the geopolitical chessboard and national security specifically. And then you see this action in Venezuela. And you've got to assume that any of the BRICS countries who now see the US come in and they're sitting on top of the oil reserves and the gold reserves, are saying, we felt like we needed to get our money, shift out of paper fiat currencies into hard assets before this, but now we really got to, we got to hurry it up.
Yeah. And, so I talked to Andy Schechtman a lot. He's the CEO of Miles Franklin, and it's Thoughtful Money's endorsed precious metals solutions provider. And Andy is in the trenches. He's out there buying and selling, wholesale and then retail. So, what I love talking to him about is he's really got a good insider sense on what's happening, in the plumbing of the system. And this really does seem to be a story of shortage of supply, of physical supply. And, there's lots of things you can do to monkey with financial assets, but you can't really monkey with ounces much, right?
Yeah, you can rehypothecate paper gold as much as you want, but when someone actually demands delivery, you actually have to have the bars or coins or whatever it is to deliver. And it's interesting because this, I know we'll get to it in a little bit, but it gets back to the outlook for GDP, because everyone's now touting this 5% plus GDP number in the fourth quarter that we're going to get. But a huge part of that is gold exports.
Right.
And so, we can go through the numbers, but it's not a reflection of strength in the economy. Quite the contrary, it's a reflection of the crumbling confidence in the dollar and fiat money in general, in that people aren't even content to hold gold virtually. They actually want to physically have it. And so I think part of that, again, goes back to the administration's push, which obviously I happen to support. I think it's a noble endeavor to try to, this peace through strength. And, we don't want these crazy dictators running country. We certainly don't want China with its Belt and Road to come in and really be determining what's going on in South America in our hemisphere,
right,
or Greenland, for example. So, I understand all of that. I just think that the unintended consequence of those policies has been to accelerate the diversification out of the dollar into hard assets. And frankly, there's no indication why that should change. It's not like the administration is suddenly going to say, oh, okay, we're going to abandon our efforts on this front, nor necessarily should they, but we'll have to, pay the price in terms of this weaker dollar. And frankly, I'm not sure that that's anything that the administration is really that negative on. I think Trump is generally...
Well, because it helps with trade. Yeah.
Yes. Yeah.
Yeah. Okay. So, look, Steph, we could spend the whole time just talking about the precious metals. We got a ton of other topics I'd love to try to get to in the time we have here, but let's get to the key questions on the precious metals here. So I don't even know. I've lost track. Silver's up, what, 140% or something like that?
It was 25 at the beginning of last year, wasn't it? Yeah. Somewhere around, it was under 30. So it's almost tripled.
So yeah, is that over a double? I don't know. It's crazy. And gold is, like I said, it's at all-time highs too. I mean, so the tractor beam to $100 silver, I think, is pretty locked in at this point. No guarantees we'll get there, but the closer we get to 100, the more everybody wants to pull it there. At 46 something hundred, 5,000 gold is starting to pull its tractor beam too to that price. So there very well could still be some momentum here, particularly because we've got the pull of those large rod numbers, which aren't that far away anymore. But given how far it's all come this fast, do you have a formula at which you're like, okay, the gains have been too good in so short of a time, I need to take some gains here. And if you do have a plan to sell or a strategy for selling, what do you put it into? Especially if you've got concerns about, the fiat currency purchasing power and all that stuff.
Yeah. I mean, I think unless or until there's some policy shift that is going to somehow shore up support for the dollar. And not just here in the US, but a similar implementation of policies in the G7, it's hard to argue that gold is going to go lower. It just seems like maybe it's not going to keep going up at this rate. And I would be very surprised if it did keep going up at this rate. Mm-hmm. But the argument for selling strikes me as fairly threadbare right now. And I think one of the things as we come into this year, and we've got the impact of the One Big Beautiful Bill with the change in tax withholdings and the huge 150 billion plus tax refunds that will be coming. Now we've got retail gasoline prices below $3 a gallon, which is, a huge relief to low-end consumers. With the economy, the outlook for growth is obviously stronger, but along with that, the outlook for inflation is also hotter. And then as you see, this shift toward actual hard assets, you're seeing that reflected in commodity prices more broadly, mm-hmm. which again, is the tinder into things like the PPI, which then ultimately feeds through to the CPI. So yeah. I think we're in an environment where just stepping back and looking at the administration's efforts to have more stimulative monetary and fiscal policies, that you should generally assume that inflation is going to tilt hotter than cooler. And that creates this kind of tension between interest rates, and the objectives of the administration, because they obviously are pushing very hard for the Fed to be very accommodative. Mm-hmm. But if growth is strong and inflation is heating back up, what is the case for that? And if they do go ahead and ignore those indicators that inflation is starting to pick back up again, and the Fed cuts rates or, expands its balance sheet anyway, then you're just putting more pressure on the currency as a valve for those sins.
Right.
Which again, inures even more to the benefit of gold. So I guess, right now, when I step back and look at 2026, and it seems very clear for the first 2 weeks of the year that the administration is all in on the midterms, and that they are going to.
All right, folks, you're probably seeing Steph freeze,
Sorry,
which is what I'm seeing.
You lose me for a minute there.
She's back. So you froze, but I think you're getting to a point that I was going to talk with you about anyways. You've crammed like 5 subjects I wanted to talk with you about into this past answer, which is awesome. But it sounds like I think you were about to say, it looks like the administration's going to do whatever it can to run the economy as hot as possible up to the midterm elections to try to hold on to yes. Congress.
Yes, absolutely. And so you want to be positioned for, stronger inflation readings, okay. which obviously would be negative in terms of this issue we've been fighting all along, which is that long rates have refused to come down. And if they didn't come down last year, what's the argument for them coming down against a backdrop of highly stimulative monetary and fiscal policy?
Okay, so I got a whole bunch of questions here for you. Let's just try to bang through them real quick. So what I took away from what you said to the earlier question of what do you sell your gold for, I'm taking from you, hey, until and unless we adopt a very different form of monetary and economic policy, you're not selling your ounces. Miners might be a different story, and we can talk about that in just a little bit. But am I correct in that?
Yeah, absolutely. I mean, I think that, as loath as I am to say it, we're on the doorstep of a regime change in terms of the monetary.
Okay. Steph, you froze up there again. If you can hear me, what you might want to do is just hop out of StreamYard and hop back in. Folks, while we're waiting for her to rejoin us here, I'll tell you what I'm going to talk with her about when she gets back in here. So Stephanie, has been there she is. Stephanie has been she's sort of been on team disinflation and deflation for all of the economic concerns that she and I have talked about for many prior appearances on this channel.
Sorry.
No, that's okay. That's okay. But you're back. Okay.
I was trying to check going on with my internet, and I was trying to figure out.
Okay. Yeah, you're still kind of freezing up on us, Steph, here. So folks, hang with us. We'll give Steph a moment or two to keep trying to troubleshoot here. Steph must be on a dial-up modem, so this is Johnny Blades. But what's interesting, and I talked with Steph a little bit before we hopped on the camera here, is as I've been mentioning, the administration is getting increasingly aggressive in terms of its policy, economic policies. I think to try to, as we were saying there, to run the economy hot leading up to the midterm elections. I think the administration knows that affordability has been weighing hugely on people's minds. It was a big reason why Trump got elected for the second time in the first place. And so, now we've got everything they did last year with the big, beautiful bill and extending the tax cuts and the deregulation and the tariff revenue coming in and the trade deals. The administration, especially Bessent and guys like Lutnick, are saying, hey, that's going to create a bunch of tailwinds for this coming year. We then, as Steph just mentioned, it looks like we are definitely going to have about $150 billion or more worth of stimulus coming from the largest tax refund in history here. Folks are going to go out and spend that. And I've mentioned this on X, I just listened to an interview, which I highly recommend you listen to if you've got the time and interest. It's with Chamath Palihapitiya, one of the guys from the All In podcast, and he interviews Howard Lutnick, the Commerce Secretary, in detail. And they really go through tariffs, and whether you hate them, whether you love them, it's really helpful in understanding kind of the logic behind how the administration thinks about using them, and also just mechanistically how they work. It's really fascinating. You hear Lutnick explain it, and you're like, wow, this really is putting a lot of money in America's pockets, a lot of net money in America's pockets, coming from the rest of the world here, not just a tax on the consumer, but really money coming from outside of our borders into our borders. And then for everything else around that, that I mentioned earlier, Lutnick saying, hey, we're going to start seeing some real tailwinds to the economy in 2026, really starting about now. And he says, look, I think easy, we're at 5% GDP growth for 2026. And I can see instances in which we're at 6% GDP growth. And so, Steph, I was sort of putting words in your mouth, so feel free to massage them in any way. But I think you, like me, are starting to shift your thinking about how bad 2026 could be, at least economically. Let's put the market aside for a second.
Yeah.
But economically, I think the recession odds are lessening because of all this, all these tailwinds to the economy that the administration is forcing onto the economy, if we'll say, and that likely, it's probably not going to be a year the wheels come off the economy. Not going to say never. I'm just saying those odds are dwindling. And so folks like you and I, who were pretty pessimistic about the economy, say a quarter ago, I'm less pessimistic on its performance in 2026. And let me just say one last thing, Steph, and I'll let you respond to all this. Is, when Trump came out with the we're gonna buy 200 billion of mortgage-backed securities, I was like, you know what? I hate that. I totally hate it. But I'm like, okay, now I'm convinced the administration's going to do whatever it takes to prop things up. To me, that was a clear sign that they're like, I don't care, whatever we have to do, no matter how odious we think it might be, we're going to just do everything we can to hopefully get the average person to feel a little bit better about their personal finances when they walk into the voting booth in November.
Yeah, absolutely. The problem is, of course, in the details. So, as is always the case. And this is a topic that I've been really, because I came to the same conclusion as you, is it was pretty clear they're just going to throw everything at the wall on the affordability issue and try to get that midterm vote shored up. But what they're trying to do essentially is to bring up the bottom of the K. This whole K-shaped economy notion. And essentially what they're saying is we're now singularly focused on the bottom of the K. And to bring the bottom of the K up, let's use a couple of examples. Number one, they're talking about capping credit card rates at 10%. Well, as all the big CEOs come out and said, it's not a viable business model for us at 10%. Now, maybe that's an exaggeration. It's probably viable at some number between 10 and 28, which they're currently charging, But the point is, so it'll be a negotiation. But ultimately, there are unintended consequences of the administration coming in. It's the equivalent of wage and price controls coming in and saying, this is the interest rate that you're allowed to charge, at which point the banks will say, okay, well, we're not going to lend to those low quality people.
Yeah, exactly.
Doesn't justify the risk of being exposed to those people. So now, and I was talking to one of my clients who's a financials guy, all he does is financials, over the weekend after that credit card tweet went out about the impact, perversely, on driving people to buy now, pay later options, which are probably even more fraught with risk, because if you can't borrow on your credit card, well, you'll do all these other things and go to, back in the day when payday lenders actually were flush. So now it's replaced by buy now, pay later. But so there are unintended consequences of these things that aren't great in the long run. And then you look at housing, and this is the one that I think is the most important, is it's obviously the key to the affordability issue. And right now, the administration is trying everything to get mortgage rates down. And this idea of having Fannie Freddie buy $200 billion in MBS is great, except that they ramped up their purchases last year. They had been buying all along behind the curtain that people weren't paying attention to. So they have already been ramping up their purchases. All that's accomplished this year is that they're going to kind of sustain that pace. And it's just going to offset the QT that the Fed is still doing on MBS in its own book. So it's essentially a wash. I don't see that that's going to materially move the needle on mortgage rates. It didn't move the needle last year. And this year, they're fighting the Federal Reserve balance sheet unless or until that changes, which is another concept that I think will happen down the road. But in the meantime, given the policies as stated now, I don't expect a whole lot of relief on the mortgage rate side to happen, which means
which is what we don't need. I mean, if we're trying, look, I get politically, you don't want people to feel like their houses are going down in value, right? But at the same time, if the issue is unaffordability, they need lower home prices. That's the answer.
But that's the thing. So that's exactly where I was going is, okay, if the rates aren't going to be the relief, it's got to be the prices. And if it's the prices, then what you're doing is you're taking the top end of the K and saying, you're going to go down so that these guys, first-time home buyers, can finally afford a home. You're going to take a hit to your net worth by having your housing, which is your number one asset in most people's case, go lower. It also, from a nerdy economist standpoint, is the asset that has the largest wealth effect because it's so important. So it is generally understood that the impact of the wealth effect from housing is 10 times that of stocks. So as much as the administration has this noble goal of improving affordability, the downside of capping or even, cutting out, causing a decline in that real estate net worth for the high end could more than offset the benefit in terms of the whole impact on the economy. Now, you'll get confidence boosted at the low end, but at the expense of the high end. And as we know, awful as it is, the high end is the engine that drives this economy. So, it's a push-pull because they might get more votes at the low end because people start to feel relief, but it will come at the expense of, a very important sort of constituent to them. So, this is the bigger question for me is all this policy making that's so frenetic and is clearly designed to focus on the bottom of the K. And, he said on the campaign trail, and Bessent reiterated it, Wall Street's had their day. It's Main Street's turn. And Wall Street ignored that message and just was like, yeah, whatever, it'll be fine for us. Now this is the risk for the economy this year. It's not from a macroeconomic standpoint. It's that the equity market begins to fall apart. And that's the risk to the economy, is that this increase in volatility associated with staying up on Saturday nights to read True Social tweets and try to figure out what it means for your, trades on Monday, begins to unnerve and rattle investors. And we see a risk-off move. And that would be the thing that would pull the rug out from the economy. That's the concern I have now.
Okay, so that's a great point. A couple of things. First off, not surprised that Wall Street has shrugged it off, right? Because, stocks are pretty much near all-time highs right now, right? Whatever, you say whatever you want, my assets keep going up and you're fighting to bring rates down, like you're doing everything that asset owners love, right? So they haven't really felt any pain yet. And one thing I've been saying recently, and I mentioned it earlier, that while I'm becoming more optimistic that the economy will have a better year than I initially thought, that doesn't mean the markets are going to have a better year. And I think for so long, they've been so tightly correlated that everybody just thinks of the same thing. And as you and I have talked about, Stephanie, over time, the market got so big, it really became the tail that wagged the dog, right? So everybody now thinks, well, the market dictates what's going to go on. This year, I'm not saying it's going to be, but I see an increasing probability or possibility that we could have an economy that does this while we have a market that does that, right? Yeah.
No, I think the only concern about that, again, is the impact on the high end, and numerically, just mathematically, if they pull back from spending, the impact that would have. There's also if they actually do impose things like, say, for example, a 10% cap on credit cards, there is a profit impact there for banks. So their profits will go from absurdly large to modestly large, but that has an impact that ripples through the economy as well. And obviously, if we do start imposing caps on different rates they can charge, you're basically cutting off the credit lever that also is a key driver of growth for the economy. So I guess my point is just, there are a ton of risks out there, and the markets, as ever, until just recently, seem to be priced for zero risks and everything just being smooth sailing, and none of the narratives strung together. The economy was going to be strong, but the Fed was going to cut rates 100 basis points, and everything was going to be great. And I don't know, the profits are going to be double digits and stocks were going to grow to the moon. But the Fed had to ease for no apparent reason.
We haven't even talked yet about the investigation of Powell. If we have time, we'll get there. But let me pull on a couple of things that you mentioned here. So you seem to think that that the impact of the policies that the administration is aggressively pursuing here may likely be inflationary, right? And you already explained why. Let me ask you this. So I get the argument, but I look at two really key components into inflation, at least as measured by CPI, right? And one is housing.
Yeah.
Right. And you don't expect the mortgage-backed securities purchasing to really make that much of a difference.
Yeah.
And housing is disinflating and deflating, depending on what market you're in.
Yeah.
Right. And it's 40% of the calculation for CPI. So I think there's a mathematical bias to disinflation in 2026, just all things being equal.
Yeah.
Right. And with a 40% share of the calculation, where housing goes, kind of where CPI goes for the most part.
Yeah.
Then we also have oil, and I want to ask you some questions about oil in a bit if we have time. But oil prices are low, and there's a lot of things that are happening that could keep oil prices lower. Right. Mm-hmm. I mean, the whole Venezuela thing. If we happen to have peace in the Ukraine at some point this year, whatever. But there are things that keep that energy input cost low, right? You mentioned consumers love low gas prices, but you also love the oil goes into everything. So when oil price is low, that has a deflationary effect and other things. So I guess my point is could housing and oil, what's happening there, could that offset any inflationary impact of what the administration's doing? So I don't know, maybe we don't have rising inflation, maybe we don't have falling inflation, but we just kind of hang out here because they're counterbalancing each other.
Yeah, well, I mean, that would obviously be the hope. I guess I agree with you on the housing side, and I'm a little bit less convinced on the energy side, because I just think that commodity prices in general and energy in particular is going to be an area that people are going to start to get aggressive on. People are going to realize, for example, AI that you and I have talked about endlessly, relying on all this energy, and promising as things like Venezuela are and potential end for this Russia-Ukraine situation, and who knows what happens in Iran. That could be another very positive development. That first off, in Venezuela, it's going to be years, if not a decade, before any of that oil actually can be. It's also a different kind of oil, from what I understand. It involves a lot of heavy refining.
Right, but we like that oil because our refineries can deal with it. But it's something that's going to take years from when we
exactly. It's not like we just flip a switch and all of a sudden oil is flowing from Venezuela. So that would be nice, but that doesn't seem to be the case. So I guess what I kind of go back and forth on is we've got these cyclical forces and secular forces. And the cyclical forces you just outlined very well, that could cause these prices to go lower. But there's the secular demand for resources that is strong and intensifying because of the actions of the administration. I feel like, there's this Cold War for resources, and the curtain has been lifted. We now see that we're in a Cold War for resources. The US has been asleep. So is the Western world, basically, while China has been waging this Cold War for over a decade. They started their Belt and Road Initiative in 2013 and have been securing resources all over the globe, including in our backyard, that the administration has now woken up to and is taking steps to kind of counteract. But that just intensifies this demand to secure those resources. So I don't necessarily see the case for substantially lower prices there. Now, yes, I mean, there will be cyclical ebbs and flows, but secularly, I think commodities are going to be bid. And as we saw this morning with the PPI, those are still feeding through. They're still the thing that's pushing prices higher. Like in the PPI, services wasn't the surprise higher. It was the commodity side. Right. And I expect that that's going to continue. And then the question is the disinflation in the services sector and things like, rental, homeowners equivalent rent or whatever sufficient to offset that from the standpoint of the headline numbers? But also, is it sufficient to produce a sense of improved affordability among those low-end consumers? And, the jury is out on it now, and we'll see how the year progresses. But I agree with you just broadly that the outlook for growth is better than it was last year. But the idea that we can have stronger growth with a disinflationary backdrop at a time when we're running monetary and fiscal policy hot is one that I just, maybe it'll happen, but it just intuitively is hard for me to square. And the only way I could square it is if you have disinflation or deflation in asset prices that causes that kind of knock-on effect in the economy.
What'll be interesting is, my opinion doesn't have to be yours, but I think the thing that's going to make the biggest impact in folks' decision when they pull the voting lever, or I guess in modern day when you press the voting button, is going to be their confidence about their job or their ability to get another job. And, as you and I have been talking about forever, Steph, the job market has been weaker than reported. I mean, it's hanging in there. And again, I think the unemployment rate just went down in the last last jobs report we just got. But companies aren't hiring.
Yeah.
Right. And the quits rate's really low, which is a sign that the employee is scared. Right. Now, Trump just did a address last night from a factory floor, up in Detroit. If we can get enough of these jobs, the data center jobs, more manufacturing coming back, stuff like that. Whereas even if someone's not feeling better yet, but they're not feeling worse, but they just feel more confident that, my buddies are getting jobs. If I threw my hat in the ring, I could probably get a new one. That'll probably make a big difference. The question is can we get to that point in the economy if we have a big correction in the stock market where companies are all of a sudden, being forced to make tough decisions? So I don't know. I mean, to the title of this live stream here, I think it's going to be a wild ride this year. I think it's just going to be a year of massive cross currents.
I totally agree. And that's the thing, like volatility is very cheap right now. So, I mean, that seems like the obvious conclusion is to just get long volatility because it's going to be choppy. And I mean, we've seen that so far in the first couple of weeks of the year. And again, we're really kind of just sitting here watching this policy scattershot coming with all new ideas every minute for ways to shore up this affordability argument. So I think the point is like nothing is off the table when it comes to policy right now.
Right.
And what I want,
maybe everybody gets their own 5 acres in Greenland.
It could be. Oh my God. But what I wonder is if we get to a point where, and you started to see it after this credit card cap announcement on Friday, coming on Monday, and the market immediately is like, whoa, we don't like this. If there's a point where Trump, having been so tied to the market, he constantly points to the stock market as a reflection of his success. If there's a point at which he is chastened by a decline in the markets to kind of back away from certain policies, or whether he actually said, I'm going to sacrifice that top end of the K so that I can bring that affordability home.
Down. Well, here's a question. Okay, leans more Trump than not, right? Leads more Trump than, say,
the bottom of the K.
No, I'm going to say the top of the K.
Oh, okay.
Right? Your asset owners, right? You love things that have assets go up. First term under Trump so far, you've gotten a great ride in your assets. Your taxes, the tax cuts were made permanent, right? If you own a company, deregulation's helping you out, right? So the question is the Democrats, and look, neither of us are political analysts, so folks take this with a massive boulder of salt. But like, let's say Trump says to them, all right, you know what, it's Main Street's term, and I'm helping mainstream out this year, right? And the market's correct. Are you really going to switch and jump from Republican to Democrat? Are you really going to think that progressive policies are going to be more favorable to you as an asset owner and a business owner? I don't know. I think he might be making that bet, which is like, where are you going to go?
Right. Yeah, it could be. Although, I wonder how much, when you look at these people who are protesting against him, they seem like, well, I really shouldn't even say what they do. But I mean, these are people who probably aren't on welfare. These seem like people, women who went to Wellesley, basically. I'm going to just
although they're not on welfare, but a lot of them are older, and so they're Social Security dependent, right? I mean, they're pro government. And look, I'm painting with a massive brush here, folks. So apologize for the stereotypes and whatnot, but they may be on a form of government support.
Yeah, definitely older. So that,
I guess if they went to Wellesley, they're probably doing okay. But
yeah, I don't know. I mean, I don't want to underestimate the willingness of the voting public to vote for things that are not ultimately in their best interests. And I say that as a former New Yorker who just watched the city vote for a socialist.
Yeah.
So, and that is the financial capital of the world. So,
I mean, the irony there is unbelievable.
right.
You know, the first American city to go socialist, New York would have been at the bottom of my list of predictions. Yeah.
Yeah. So I'm loath to underestimate the stupidity of the average.
Well, let me ask you this. This is kind of really the question I meant to ask is, I have felt going into this year, the default is that the administration is going to lose Congress. You'll probably lose the House, might keep the Senate, right? But it's the odds aren't good. They're just not good historically.
Right.
And you know, the bottom half, 80% plus on the bottom half of the K, not feeling very happy. So I guess my question to you is given this kind of aggressive tornado of let's do whatever it takes, do you think that is improving the odds? I mean, do you think that the administration could actually hold on to the House given all of this, or is this likely, to your point, you know, maybe to backfire on them because it's going to create unintended consequences like more inflation or other things?
I obviously worry about the unintended consequences, but I think in terms of messaging, it's clear that, you know, they are now messaging, the Republicans are messaging, and the administration is messaging on this affordability issue. So at least they're in the game, which they weren't last year. So
right, which I think we've talked about this. I think it was a huge messaging mistake. You know, that's all I would have talked about in 2025.
Yes, yeah, I wouldn't have let, you know, Biden's, obviously this all unfolded under Biden's term, and now, you know, a lot of people from his former administration are kind of pushing this argument about affordability being a problem, and the irony appears to be lost on pretty much everybody, but except maybe you and I don't know. But anyway, no,
public has short memories. Yeah.
To the extent they're in the game, yes, it definitely improves the possibility, but I definitely worry about the unintended consequences of some of the policies. But, you know, they're out there messaging it, and we'll see how. I wish I had, you know, more brilliant insights on, you know, the prospects. But I do really worry about the increase in volatility around these policies that are clearly going to run the economy hot between now and October, and how the markets might react to that. And we have to bear in mind that, you know, we aren't just talking about a stock market sitting at record highs and, you know, junk spreads that are tighter than ever. We're talking about financial markets that are levered like never before. So it only takes one little toe stub by some errant, you know, creditor somewhere to set the whole thing off. And that worries me. And then that brings me to sort of an esoteric, far-flung topic, and that is Japan. You know, we've been talking about Japan and how their rates are backing up, and they're now at the highest levels in decades.
Yep.
And so the Bank of Japan is now, you know, they've been spent since 1990 trying to defeat deflation, and now they're trying to cool runaway, what they conceive as runaway, God, I can't speak today, runaway inflation, and they're raising rates to do so. And the irony is that they're raising rates, but the currency is getting weaker and weaker and weaker. And because Japan is hugely reliant on imports, it's fanning inflation. Right. So the weaker the currency gets, the worse the inflation gets, the more they have to raise rates. And yet the raising rates isn't bolstering the currency. So where I'm going with this is that we had that shot across the bow with the yen carry trade when they first started to raise rates to fight inflation. And I think you and I talked about this, we're like, this could be a major problem because we're going to unwind this massive yen carry trade, and nothing ever happened. And I think the reason why nothing ever happened is that the currency offset the interest rate increase. You know, the yen got so weak that you still were borrowing basically free because you were borrowing in a currency that just kept going lower and lower and lower. Yeah. So you're paying some nominal interest rate. It's better than you're paying a little more than zero, but it's being offset by the currency. The risk now is that the yen is right back to the weakest level it was when they last intervened in July of 2024. So we could get a currency, you know, if the Bank of Japan says, you know, these rate hikes aren't working, the Ministry of Finance might come in and start aggressively intervening in the currency markets, and that could, still rock the boat on that carry trade. But there's another side effect of that, and that is that in order to intervene to support the yen, they have to sell dollars. And what's the easiest way to sell dollars? Is to liquidate treasury holdings.
Treasuries, yeah.
So it's just more argument for pressure on the high end, the long end yield curve.
Yeah. All right. Wild ride. Looks like it's gonna be a wild ride. Okay. So just two things to let folks know about, and this dovetails into my next question for you, Steph. One is we haven't really talked about it much, but what unfolds in Iran could have a really big impact on the world economy, and I think just the world in general. Personally, I've been pretty vocal in just my support for the popular uprising that's going on there. Who knows how that's going to unfold, but I'm certainly wishing the Iranian people well and getting the freedom that they want. So two things on that. One, a lot of dust in the air about Iran, both in terms of just what's unfolding in real time there. A question a lot of people have is, hey, wait a minute, is the US going to get mired in a war with Iran? So folks, you've seen in the past, I've done some interviews with some of the geostrategic analysts at RAIN, which is one of the top geostrategy firms out there. I just did a few recently on what was going on with Venezuela. Before that, I'd done some with an analyst, Ryan Bohl, around what was happening between Israel and Iran when they were fighting with each other. I've got Ryan coming back on tomorrow for a live stream to just answer any and all questions that you, the viewing audience, has about what's going on in Iran. So keep your eyes peeled. That'll be at 11 a.m. Eastern tomorrow, Thursday. And of course, what happens in Iran could impact the oil markets. I talked earlier about some other things that could impact the oil markets. But like you, Stephanie, we've even talked about this, I think, in several of your recent appearances. I think both you and I were getting, kind of interested in the energy space. It had been depressed for so long that some pretty good values were there, certainly just on yield alone. But, we were kind of looking out and saying, look, the world, still runs on oil. And this is a boom bust industry. And at some point, the pendulum will swing back to boom. And maybe this is a good time to start getting in. And I'd made it public that I had started getting into this space. Since I have, which has been past month or two, space has actually done pretty well. And it actually reacted pretty well to the Venezuelan news, which a lot of people thought, oh, they're going to get cratered because more oil is coming on the market. No, not true, at least not yet. And folks, I know there's been a ton of interest in learning more about this space. I am in talks with Rick Rule to come on and do a deep dive on just oil and gas. I literally was just emailing with him on this yesterday again. I'm going to try to get that booked as soon as Rick's schedule allows. Hopefully it's going to happen in the next 2 or 3 weeks, but just know that that's coming. But Steph, I joked, 3-4 months ago that, I've got my silver laser eyes on right now in my X profile, and I'm going to take full credit that's what's gotten silver.
You should.
Right? I put them on at 35 when it had that breakthrough.
Wow.
And I've kept them on since. But I've increasingly joked about, when I retire the silver laser eyes, I might put oil eyes on there, right? I'm still trying to think through that, but because there are some developments here that are making me try to think through the second and third derivative effects on the oil price. But let me just ask the question to you. Let's say the time comes when you think gold and silver have completed the majority of their run. You think they're going to do at least in this cycle. Sounds like maybe you're not going to sell your physical ounces per se, but let's say your mining stocks. If you feel like, okay, those things have had their run.
Yep.
You thinking of transitioning those proceeds into oil?
Absolutely.
Or oil and gas?
Energy, yeah. The whole energy, the entire energy complex, I think. Yeah. And the Iran thing is, obviously, I'm not a geopolitical strategist or anything like that, but I think that has the potential to be the most important development on the global stage as relates to what the administration is doing. Because if they overthrow the government and we see regime change in Iran, then you have basically cut out from Russia and China this axis that China, Russia, Iran, and Venezuela to some extent. You know, you've already got Venezuela. If you take Iran out, you've really isolated China and Russia, and they're kind of on an island unto themselves.
Right. And maybe with North Korea, but you know, it's a small player.
Right. But I think that could have massive consequences, like positive consequences for the globe and for the US over the long term. But as relates to energy, I mean, again, I think that it's all upside. Even if you overthrow the government there, you know, the oil that's there is the oil that's there. It's just, where is it going to end up going? You know, right now it's going to China. So now it'll flow elsewhere. But, you know, I guess ultimately that doesn't make me bearish on oil is what I'm saying. I mean, I think it's more of a positive in terms of the long-term setup for the US, and probably would give the dollar a bid. But ultimately, you know, I don't know that it materially changes this demand for resources that we're talking about. And, you know, there's just a finite, this is the beauty about hard assets, is there's a finite amount of them. And we've spent the last several decades basically manufacturing paper. And now we're discovering that there's a massive imbalance between the amount of paper claims we've printed versus the hard assets upon which the delivery of all of that good stuff depends ultimately.
It's the difference between bits and atoms, right? You can create as many bits as you want, but there's a finite number of atoms in the world.
Oh, I thought you were talking about atoms, like.
Yeah, I know. That's why I had to clarify. Okay, so you know we'll continue on this theme of energy in your future appearances, Stephanie, and I'll hopefully have something more intelligent to say about it once Rich come on and I've learned from him.
You have a lot more intelligent to say about it than I do. I mean, it's hard because there's so many cross currents and things are moving a lot, and there's a lot up in the air geopolitically and economically as we turn the page here to 2026. But it's going to be an interesting year for sure.
All right. So on that, you know, if I'm remembering correctly, your portfolio, which you've been kindly transparent about, has been largely made up of precious metals plays and T-bills. And I think maybe you were starting to nibble on energy.
Yep. Yeah.
Okay. Has any of that changed, or is that still your current position given the world as it is right now?
No, I mean, I just have less cash and more energy exposure than I had before because that's how I deployed some of the cash, you know, as the Fed started cutting rates. So
are you dollar cost averaging that, or has it just been in discrete chunks?
No, I mean, it's just whenever I'm like, oh, you know what, now's a great time to start putting a little more money to work there. So, you know, I'm like the typical person, I guess. I'd like to think it's fairly typical in this business, who spends so much time talking to other people about the markets that I don't really focus on my own portfolio very much. I sort of set it and forget it. And I've also had a very long-term view. So it's not like I've been positioning gold as a 3-month or 6-month trade. I've had that position on for a long time. So I don't, you know, do a lot of trading in my account, and it comes in lumps. Let's put it that way.
Well, Stephanie, let me just share with you that, you know, I mentioned I put out on X that you were going to be on today. There was a fair amount of posts there just saying, you know what, I got into precious metals 12 months ago because of, you know, what you and Stephanie were saying. And, you know, I just basically a lot of goodwill coming to you. Now, yeah, and I think you deserve 100% of that. I feel a little bit like, you know, maybe that person started watching 12 months ago. So if they'd been watching 5 years ago, they might have felt a little bit like, well, I had to wait a lot for this, right? But you have helped a lot of people in the near term who have been convinced by, you know, your strong championing of the precious metals. A couple other questions that have users asked, and then we'll start wrapping up. One is they just wanted to get your general outlook for the housing market for 2026.
Yeah.
I know you're not a housing analyst, but you think a lot about it. So where do you think it's likely to go?
Well, to the extent that I am highly skeptical about the likelihood that these efforts to lower mortgage rates are actually going to succeed, don't really see much relief on the mortgage rate side. And that does leave me concerned about prices doing the heavy lifting, which, again, will create tremendous opportunities for people like myself who sold and I'm sitting here renting, waiting for prices to come down so I can get a better entry point. But it will come at the expense, again, of those people who are sitting on equity. And it's important to point out, too, that over the last year, we've seen a huge increase in cash out refi. So a lot of people, who were turned off by the prospect of borrowing at 28% rates on their credit cards have been extracting equity from their homes to generate cash. And so that leaves them more vulnerable to any kind of decline in price. Now, I'm not predicting, a 2005, 6, type of bursting of a housing bubble situation, but I do think that prices are more likely to go down than up. And one thing that another myth I'd like to dispel is this myth that there is a shortage of housing supply. There's no shortage of housing supply. There is a shortage of housing supply at the price that people are willing to list it for right now. So you see this really clearly in the bifurcation between new and existing homes, where new home sales, if you think about a builder developing a whole project, he's going to be much more flexible in terms of prices that he's going to offer or rates. Right. Than someone who's sitting in a home who has a 3.5% or 4% mortgage, who's reluctant to sell and then have to turn around and buy a home at 6 or 6.5. Right. So you see the new home prices have come down and are now, for the first time, I think, in history, lower than existing home prices. Yeah. So it tells you a lot about the dynamics.
Yeah. And that's, I think that lower price, I think that's still sticker, right? In other words, like when you factor in all the mortgage buy downs and the benage that they throw in on top of that, to your point, the new home market is showing us where it all needs to go, which is the price just needs to be lower, right?
Exactly. Yeah. And what you also have in the background is this massive inventory that's about to come on the market of homes that are in some stage of construction. And I'm sitting here talking to you, looking out at a massive building that's going up here in West Palm Beach, right next to a one that was just completed, between another one that was just completed.
Right. But you live in a strange place, right? Because I mean, you live in one of the few places that's still red hot, and that's because everybody who's leaving the New Yorks and Chicagos and Californias of the world are moving to your town. So yes, but that's true. There still is in a bunch of other. I mean, what's interesting about where you live in Florida is it is totally a tale of two worlds, right? You've got some places like where you live that are still doing great, but you got a lot of places in your state that have had a 2008 style correction.
Yep. Well, and then you have these older buildings, and it's interesting. This is a really interesting strip that I'm looking at out the window here. There's an older building where everyone's probably in their 70s and has owned their units forever, and they're facing assessments to upgrade the building, and a lot of people can't afford to pay those assessments, so that's a real problem. And it's wedged between two buildings where the starting condo is $5-6 million on the ground floor, and the penthouse is $40 million. It's insane. So, but it is a tale of two worlds there. But ultimately, I think that there's a huge amount of supply. If you look at the housing that's under construction or completed, and you add in, starts, it's as high as it was during the housing bubble. That's the only time it's ever been this high. Wow. So you have a huge shadow inventory that as it starts to hit the market is going to depress prices. So I just want to eradicate the myth that there's a shortage of supply. There's no shortage of housing supply at all. And I think we're going to find that out soon.
So I've ranted about this as well, Steph. I agree with everything you've said. The other thing I would add to it is, what I often say is, I don't think we have a shortage of housing units in this country. We have a very stark imbalance of who owns them. A lot of them are investor owned. And the investors had a great time for a long time, especially during COVID, right? But now we're at a point where a lot of those guys are, they're now, those properties are cash flowing negative. And presumably, the longer that lasts, that inventory is going to keep coming out of the market as well. So I'm sensitive, and I agree that, look, in some areas, yeah, we do need to build more. We need to,
right.
try to get rid of some of the red tape. But I think if we just said, hey, look, do we really want to have, I think it's something like a third of single family homes are owned by an investor, whether it's a mom and pop, and it's mostly mom and pops, but increasingly over the recent years, it's been Airbnbers and institutions as well. I do think, and I always get in trouble for this, but I do think we should have a national conversation to say, does it serve us to have investors owning that much of the single family home fleet, homes that are really supposed to be shelter for families.
Right.
And we just saw Trump, put out the trial balloon of, hey, I'm now declaring that institutions can't buy anymore. It wouldn't surprise me over time if we started to see more and more restrictions on what investors could do there, and that would free up a lot of inventory.
Yeah.
Right. So anyways.
But at a price, because, if these guys have to liquidate those portfolios at distressed values or whatever, then there are financial consequences to that too.
Sure.
And also, we also have to look back to when they started buying, and they created a market that, they stepped up into a vacuum. So we loved them when they came in and started buying up properties, but now they own too many. So it's very hard to have both sides of the argument. And I get it. I don't love the idea that they own a third basically of single family homes. I think that's, creates obviously a problem. But we're in this, we should have anticipated what the implications would be before they came in.
Absolutely. That's the problem with letting the camel into the tent, right?
Yeah. Exactly.
It seems great at the start, and then you have, and now it's like, well, we're going to crater the market if we get it. We never should have let you in, right?
Exactly.
Again, different rant for a different day. All right. Okay, we're gonna end on probably something even a little darker, and I apologize for that. This is the tweet. Literally starts with, "This is dark, but does Stephanie envision social instability arriving in our country, and what could be the catalyst? Does she prep for any type of social instability or fourth turning type of crescendo?" Yeah, it's a dark question for such a pretty person, but just wondering.
Yeah. I mean, it's scary, because I was actually thinking this thought yesterday as I watched the news reports of, what's going on in Minneapolis or all over Minnesota. And it does seem like
oh gosh, Steph, you froze up right when you got to the super interesting part there. All right, folks, hopefully she's going to rejoin.
I think I'm back.
Are you back? Okay, sorry. You froze right at the start of your answer there.
Okay, yeah. Did I get to the part of watching the news stories out of Minnesota and how, these...
That's right where we lost you.
Okay.
Minnesota.
It's hard not to feel, watching that, like there's an effort being made by some groups to foment instability, and that, they're really... It just feels like there is an effort I hate to be dark like that, to try to create some social unrest there and blow this into a bigger, it already has reminiscences of George Floyd. And if it became a larger nationwide situation, these things can devolve pretty quickly. So it's not a question that I haven't contemplated and I don't worry about. I don't really know how to prepare other than what I have, which is a Glock and my gold and my bulldog. So frankly,
so golden lead basically is what.
But I actually heard someone on some news story today talking about how they felt. I think it was they were replaying a comment by one of the what do they call the AOC and her gaggle of women? What are they called? The squad. Thank you. God, I literally am out of it today. So they quoted one of them saying that essentially, oh my God, I'm totally losing this comment, but yeah, I'm sorry, Adam. I'm just so down the rabbit hole.
To the spirit of the question, I mean, how much of your mind share, if any, is spent thinking that like, okay, this could go just beyond my concerns about the economy or the financial markets into real social instability that, I, Stephanie, might need to worry about stepping, out of my house into the street one day?
Yeah, well, I guess that's why I moved to Florida from Manhattan. So I wouldn't have to worry about that as much, because it really, I mean, even during COVID, that was a consideration. And now I'd be very uncomfortable being around there. But I feel like, I'm not someone who necessarily lives my life looking over my shoulder, and maybe that's not a good thing, but I try not to expend a lot of mental energy worrying about things that I can't do anything about. But, I don't want to be cavalier about it, because it's a risk, and it is a function in large part of how long and how persistent this bifurcation between the high end and the low end has been allowed to continue. And, it would be great if we could rectify that problem without having to have any kind of social consequences and have the consequences be purely economic and financial. But I think that's a little bit of a pipe dream, because, it could involve pain that ultimately manifests in some social unrest. So I guess this is kind of a long-winded way of saying I don't rule the risk out. I try not to really expend a lot of time and energy contemplating it, but I'm definitely mindful that it could happen. And as I watch what's happening in Minnesota, I definitely am keeping an eye on any potential echoes elsewhere in the country. I'd be interested in what you say to that question, Adam, because you've been on this topic for a long time.
Well, for folks that know, the previous companies that I was involved with, I spent the better part of a decade kind of focusing on this type of stuff. The short answer for me, it's all about resilience, and just not to make this a super long answer. If folks are familiar with the book that I co-authored called Prosper, it goes into kind of how to build resilience in your life. And the shorthand of that is these are steps that you can take in your life across all facets of your life that if we go full forth turning and there's Lord of the Flies out there in the world and supply chains break down, all that stuff, you will be less vulnerable to those forces. But if the world just keeps chugging along, these are things that are still additive to your quality of life, right? You're not going to look back and regret that, my goodness, why did I invest more in my health? Why did I learn more skills that are practical? Why did I build community and have tighter social bonds, right? These are things that are just good no matter what type of times you live in. So from my perspective, it's just, I live my life according to that framework. So yeah, short answer is cultivate resilience. It only has good benefits for you. All right, well, look, in wrapping up, Stephanie, thank you again. These are wonderful, and it's so great to see you. I will say though, real quick on the resilience side of things, one of the things that you are doing well, Stephanie, by helping so many people, is you're building your own form of social capital, where there are a bunch of people who are deservedly fans of yours because you've legitimately helped them out. And so, if you were ever to fall on tough times and need to get out of your place there in Florida, I'm sure there's a lot of safe places for you to land. And of course, my house in Reno is one of them. You come hang out with Ashley in the great free state of Nevada if you ever need to. But that is one important investment that you're making with your time here, whether you are aware of it or not. All right, and wrapping up, Steph, just again, give folks a quick reminder of where they can go learn more about your upcoming conference on February 17th and
18th. Absolutely. I'll pin it on my Twitter feed, but at Pomboy on Twitter. And you can register. I'll put the link there to register. It's only a month away, so we're only have a few tickets left, but there are options to do a VIP, extended VIP thing. The conference is on the 17th. We have a VIP day on the 18th, which will include some real quality FaceTime with the likes of the two of us and a bunch of other interesting people, and a boat excursion, and it's going to be great. So I'll post that on my Twitter. And then for people who want to learn about Macro Mavens, they can go to my website, macromavens.com, and learn how to subscribe and all that jazz. And I promise next time I'll have better internet, and my brain will also be functioning so that the words that are in my brain actually come out of my mouth.
No, I know it's hard to be on when you're worried about your internet connection and stuff like that. So don't worry about it. All right, and folks, yes, macromavens.com. If you want to follow Stephanie in between her monthly appearances here, well, then just go and subscribe to her work there at Macro Mavens. All right, well, in wrapping up real quick here, folks, if you want to get some professional help from a professional advisor who takes into account all the macro issues that Stephanie and I have talked about here, in hopefully figuring out how best to navigate your financial wealth through what looks like it's going to be a pretty wild year ahead. Obviously, you can go fill out the short form at thoughtfulmoney.com there and talk to one of the financial advisors that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. It only takes you a couple of seconds to fill out the form there. The consultations you'll have are completely free. There's no commitments involved. It's just a service these firms offer to be as helpful to as many people as possible. Lastly, I just want to remind folks that the special offer that Andy Scheckman and his team at Miles Franklin have created exclusively for the Thoughtful Money audience to buy junk silver. Now I think it's at $1.35 over spot. Still one of the best deals that Andy's seen in his 30-plus year career. Supplies are still lasting. So if you want to take advantage of that, go to thoughtfulmoney.com/buygold. And Andy and his team will be in touch with you right away after you fill out that form, either to help you take advantage of the junk silver offer or just to answer any other, precious metals purchasing, selling, or storage questions that you may have. Steph, it's always so wonderful. Folks, please do me a favor, hit the like button to show your appreciation for Stephanie, and definitely let her know in the live chat here, if you're watching live, or in the comment section below if you're watching the replay, how much you enjoy having her here on these monthly sessions with her, so that hopefully she wants to keep doing this with us.
Of course. I'll do this as long as you'll have me.
Well, that's easy, Steph. We'll have you forever. All right. Well, look, I know you got to go, and I've got to hop off to record my next interview in just a couple minutes. But Steph, so great to see you. Thank you. Another great, wonderful discussion as always. Really looking forward to seeing you in a month. I hope as many of the viewers here watching who can join us choose to join us there. But again, just thanks for everything.
Thank you. I guess we'll talk next, just a couple days before that conference. So that'll be great.
All right, and hopefully we can inspire any procrastinators to come join us. All right, Steph, please give Wilhelmina a good scratch behind her ears for me.
And you do the same with your two Bs.
Will do. All right, Steph, thanks so much.
Bye.
And everybody else, thanks.
I think gold is going much, much higher. Yep. I have a target of $35,000 or something like that going into early 2030s. And I think we're going to go there. I don't disagree with that. And as I just said, $35,000 per ounce. I mean, that's the highest number we have heard on gold today, right? That's my target. But what I'm saying is that does not rule out a 40% decline into a deflationary bust where the Dixie can go to 122.
You can't get rate cuts without some aggressive buying of the bond market. Who's going to rush in and buy all the US issued bonds in an aggressive way that it pushes prices up immensely, sufficiently for you to have that dip in rates that's going to lead to a 40% correction in gold?
The speaker, Henrik Seeberg, along with Francis Hunt, projects gold soaring to around $35,000 by the early 2030s, calling it their long-term target, yet warns this doesn't rule out a sharp correction along the way. They caution that a deflationary bust, driven by a surging dollar index possibly reaching 122, could trigger as much as a 40% decline in gold before the next leg higher. With current rate cut expectations and without massive, aggressive bond buying to push yields lower, they question who will step in to absorb U.S. debt, suggesting that such market stress could create the conditions for gold's temporary collapse before its eventual climb to historic highs. Francis Hunt, the market sniper, in discussion with Henrik Zeeberg and Matthew Piepenburg, noted that while some foresee a 30 to 40% correction in gold during the next crisis, such a dip would be a buying opportunity. They argue a deep collapse is unlikely since today's rally is fueled by central banks like China and Russia, not just retail investors. Even a 15 to 20% drop would likely see these nations selling treasuries to buy more gold. Still, Henrik and Matthew caution that a strong dollar spike could trigger a meaningful pullback in a deflationary bust. Henrik Zeeberg, a macroeconomist, trader, and financial strategist, countered that forced selling could still drive gold lower, whether from hedge funds in trouble, leveraged retail traders, or even stressed sovereigns liquidating reserves. Matthew Piepenburg, macro strategist, author, and investor, highlights that in such moments, liquidity needs dominate, and because debt is denominated in dollars, gold often gets sold to raise cash quickly, just as in 2008. Yet unlike that crisis, today's backdrop is very different. Central banks, the BIS, and even discussions in the U.S. point to gold's growing role in the financial system, with BRICS nations using it for settlement in trade and oil deals. This stronger structural demand suggests that while short-term volatility and corrections may occur, the long-term trajectory for gold remains firmly upward. We're about to explore the video, but first, subscribe and hit the bell icon to stay up to date with our latest uploads. Your feedback in the comments is always appreciated.
What Henrik is saying is valid. For me, again, I'm still agnostic because I started buying gold 20 years ago. If we have a 40, 30% dip in the next market crisis, I'm relatively using that as a buying opportunity. But smugly,
but hold on, you have the notion that we'd have a 40% drop in gold. What do you think?
I don't think we will. I don't think we will. But we have to. We have to. What's that?
What is China? The gold is running not because of you and I. It's running because of central bankers.
That's my view too, Francis. I agree.
If the treasury market is doing and the dollar is doing what Henrik is saying, and you're having a 40% drop in gold, if you even just get to a 20% or a 15%, what do you think China and Russia are doing with any dollars or treasuries they hold? That's amazing. Thank you for the liquidity. Have it all back. These guys, China is a patience trader. They are not a trader. They're a patience investor. They sleep on the riverbank and wait for the dead bodies of their enemies to come by. That's
why I think it's ultimately
that will absolutely unload everything into wherever the sudden liquidity is coming from. So how do you get a 40% collapse with all the major central banks, probably including Switzerland, which is supposed to be a friend, but was also been accumulating gold? Every major central bank, which is the key move the needle gold buyer, on a 40% drop. So we're at 3,300. You're talking 1,700, 1,800. Great. They're going to load up and they're going to get rid of all those treasuries. They'll be doing it long before you get that 40%. And I
don't think it tops yet. I think it has a little more a higher move than before we top, but I think the top is in around 3,700 or something like that. And then I think you're going to see with the Dixie spiking up like that, you're going to see a very large decline. And again, into a deflationary bust like what we could see here, everything is overvalued. We agree on that. Everything is overvalued.
Who's selling the gold and who's buying the treasuries?
But it's not. It will be about. Trader? Because you'll also have a situation potentially where there will be, you had a situation also where gold actually dropped because there was at least the rumors said there was a hedge fund, in problems and they had to go sell gold and you saw a large decline in that gold. I can't remember when it was not so long ago. So things can happen. If the floor opens up and a lot of people are starting to lose their money on their crazy crypto investments or whatever it's going to be, or their hedged, long,
that's retail.
Leveraged.
That's not central.
No. But
this is good. This is good. This is good because it's important to have a disagreement on the DXY. We agree on gold.
What we're actually saying is crypto kiddies that are losing money on crypto, who happen to be big gold holders, are now going to be selling their gold, and they're going to crash the gold market in an environment where the central bank
sovereign state. It can also be sovereign nations that can be in problem. Can get in problem if you start to see that they're the yield levels.
But Henrik, are you saying that in this event where the Dixie spikes in this short-term window of shit happens? Excuse my French. Is that going to be driven more by a need to sell gold for liquidity, or driven more by a need to buy U.S. Treasuries as U.S. dollars for safety in that moment?
I don't think there's either or. I think there's there'll be a plethora of things. I think it'll be driven by the need for liquidity, and the only real liquidity is where the debt is denominated in, and that will be denominated in dollars. You can't pay off your debt with gold. You need to sell gold, and the thing with gold is that it's fantastic to give you liquidity when you need it, and that's what it's there for. So you'll probably see that the sell-off will be something
what happened in 2008. I'm just trying to find
arguably, which is the 35%
but
decline.
Unlike 2008, I'm just trying to. I'm not saying this isn't a foolish argument.
No, that's fine. We just
unlike
discussing.
2008 though. Today in 2025, the mood, the need, and the status of gold, not just in the headlines, but literally at the BIS, literally at the Fed, even all this nonsense and discussion about gold-backed U.S. dollar again, and not to mention revaluation, not even going down those rabbit holes. What we're seeing with the use of BRICS gold as a trade settlement for net settling, what we're seeing in the oil trade, what we're seeing with the stacking of physical gold in the East, don't you think the environment from the BIS to the Shanghai Exchange to the SPYMEX in St. Petersburg is so different now than in 08?
Henrik suggests gold isn't in a bubble, but simply preserving value as fiat currencies weaken. Its rise may reflect a fiat bear market rather than overvaluation. Silver, platinum, and miners lag behind. Some argue gold has front-run inflation fears and could pull back if the dollar spikes, like in 2008. Others note it hasn't reached inflation-adjusted 1980 highs, and with record global debt, gold's long-term fundamentals remain strong. The broader view is that gold has solid fundamentals, unlike Bitcoin, which some describe as a bubble driven by speculation. Gold is backed by decades of central bank demand and its historic role as real money. Analysts like Francis, Matthew, and Henrik collectively highlight patterns where gold has outperformed stocks after major crises, comparing today's setup to 1929, 1971, and 2000. While a deflationary bust could temporarily make the dollar everything, forcing some gold liquidation to cover debts, the longer-term trend still points to dramatic gains. With projections as high as $35,000 by the early 2030s, gold's role as a hedge against excessive debt and fiat debasement seems more relevant than ever. Now, let's get back to the interview.
What if gold is not in a bubble at all? What if gold is simply doing what gold does best, and the only thing that's in a bubble is the U.S. dollar or the yuan or the yen?
Somebody should have told platinum, silver, and GDX.
I think the GDX, I think platinum, platinum's another conversation. I think silver always is the little speedboat that can once gold hits a bull market, but gold isn't in a bull market yet. That's why silver hasn't taken off.
But I think silver actually looks even worse than that. And we also know that normally when we have a real gold bull market, we'll see silver follow. Silver is not at all-time highs yet, and there's nobody who can tell me technically that this looks strong for silver.
Early stage.
No. This is actually late stage. This is late stage if you look technically. You have that the silver is making lower highs on a weekly basis when it moves higher. That tells us that you're moving into a level where it's probably, and I'm saying it's around 41, 40 something, 42 maybe.
Yeah, but that's
where
a
you're going to see
point.
a decline.
I also see silver being rejected in the 40s before running 50.
But this is actually a very big rejection. And it just doesn't make sense. It doesn't make sense. It doesn't make sense but gold should just keep moving higher. And silver, by the way, gets rejected at levels which are far lower than the all-time highs. And by the way, minus does the same, and so does platinum. So what if the most rational explanation is actually that gold has been front-running things a little here because everybody's been talking about inflation and how that is a problem, and that is a problem.
Devalued. It's artificially devalued.
And that is why it's going to have a relative larger pullback when the DIX is going to, when we go through this whole shit.
There's an industrial component to silver, number one. And
that's my perspective.
I get your perspective, Henrik.
That's my perspective.
And hyperstagflation, there's an industrial component.
We're not stagflation now. We 2.7%, there's no stagflation.
We are absolutely not getting consumer buying. So there's not the same.
But we have 2.7% inflation. We have 2.7% inflation. That is low historically.
You've been
very, very low.
A number of 2%.
But you don't actually believe that's the real inflation number. And silver priced in gold terms is still very cheap, as is platinum. And technicals, you guys are far better than me, but we're at a 45-year cup and handle for silver. I think silver's just waiting for gold to actually have a bull market. I don't think it's a bull market. gold is kind of itself in a bull market, maybe a little bit inflated, hype, front running, and that the real, and I'm simplifying that, when there's a real moment, that there'll be an '08 like sell off, because 2025 is very similar to '08. I would argue it's different, but if you were to change your thesis, it's a little bit, if you could think of, and maybe you don't, that it's not that gold is in any kind of a bull market. If anything, gold is doing what it always does, which is nothing. It just sits there. Well, fiat money is very busy, and sovereign debt is very busy debasing fiat money. And what we have is a major, I think, fiat bear market, and a bull market for gold is simply waiting for the fiat to die.
That we agree on.
But you don't think there's a difference in degree? That you still think the gold is overvalued given the level of U.S. or global debt? You still think it's overvalued?
No, I think, as I said also, I think gold is going much, much higher. Yep. I have a target of $35,000 or something like that going into early 2030s. And I think we're going to go there. I just want to say, like when I'm talking to Bitcoin guys also, I'm saying, you know, guys, I know the saying of institutional adaptation and all these things, you know, but by the end of the day, I think it's a bubble. Okay. And I think that's the way it is. What I see with gold is that I think gold has a fundamental and it's going to also, if I look at Bitcoin gold actually ratio, you can also see that there is something to that. Bitcoin was outperforming a little more, and then you're going to see gold actually taking over again. If you look to the SPX versus gold, you can also see that we have a similar situation like what we had in 1929, in 2000, and in 2000 actually, and also 1971. Sorry, also with Nixon. So we have a unique situation here where yes, gold is going to outperform in the longer time frame. That is if you take the dollar out of the equation. But that's not what you can do in a deflationary bust, because that is when the dollar is everything. The dollar is everything, because you need to pay your debt. So if I get it right,
when you say the dollar is everything, you're saying the debt instrument is everything too. You've got to talk about both. Who's buying the debt?
Yeah,
this is the gold bubble, apparently, according to you, at the moment. How can you? I don't see how technically you can say that. We haven't even reached 2000. The 1980s high.
I'm not.
This is adjusted for the fake statistics that you like. The BLS, these are their stats, dividing by the CPI. And that's where you are. You haven't even met the CPI adjusted high of 1980. And we are in 130% of debt in the United States, 39 trillion, where we were compared to in 1980.
While short-term volatility and even sharp corrections in gold remain possible during a deflationary bust, the long-term outlook remains overwhelmingly bullish. Central bank accumulation, rising debt burdens, and fiat currency weakness all reinforce gold's role as a core store of value. Whether or not interim sell-offs occur, the trajectory toward dramatically higher levels, potentially $35,000 by the early 2030s, reflects gold's enduring importance in an increasingly unstable financial system. If central banks continue to buy aggressively, could they prevent any major gold correction despite a dollar spike? How might silver and other precious metals respond once gold officially enters its next major bull phase? We welcome your insights in the comments section below. If you found this content valuable, don't hesitate to give it a thumbs up, and don't forget to subscribe to stay informed. Thank you for joining us on this journey.
China is buying gold like crazy. The people in China are buying gold. They love gold. And the central bank is also buying gold on a consistent monthly basis, basically. China is the largest gold producer already, and they consistently buy more gold. They use this, of course, as a way also to attack America, because gold is the antidote to the American fiat dollar money system. And they plan to build gold vaults in many other countries. Gold is clearly in a secular bull market. The only caveat would be if we see gold now really accelerating dramatically over the next few months and maybe 1-2 years, doubling in price immediately and running to maybe 8,000-9,000 in the next 1 or 2 years, then it would probably have the characteristics of more of a bubble, and we would have to be careful. But if it's just pushing higher like it's been doing now the last 14 months, I think it's very healthy, it's very sustainable.
China is both the largest gold producer and a heavy buyer, with its people and central bank consistently accumulating gold as a hedge against the US dollar. China is building vaults abroad to back trade in yuan with gold, challenging the dollar system. China's central bank has increased its holdings of gold for 10 months in a row, ending in August 2025. Their gold reserves rose to about 74.02 million fine troy ounces. Gold is in a long-term bull market, and while a sudden surge to $8,000 to $9,000 within a year or two could signal a bubble, the current steady rise looks healthy and sustainable, pointing to much higher prices ahead. Florian Grimmies, a precious metals and cryptocurrency analyst and investor, highlights that central banks in China, Russia, and India are buying gold instead of Bitcoin, while the US is pushing into digital assets to maintain dominance, raising concerns about surveillance and sustainability. A World Gold Council survey shows 76% of central banks expect to raise gold reserves in the next 5 years. China has boosted its gold reserves for 10 straight months, joining Russia and India in favoring gold over Bitcoin, which remains too volatile and unrecognized as a reserve asset. Rising stagflation risks, low growth plus high inflation, are driving demand for hedges like gold and real estate. Analysts warn that while gold's inflation-adjusted price is at record highs, steady demand could lift it toward $3,700 to $4,000 per ounce by 2026. Tracking wealth in gold or Bitcoin, rather than just dollars, shows how purchasing power continues to decline. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
The Chinese, the Russian, and the Indian central bank are buying gold and not Bitcoin. The Americans desperately need something new to continue basically running their hegemony, and apparently they decided it's going to be the digital asset space. It makes sense to a certain level. At the same time, a digital dollar as a stable coin is just really much better. No, it's not. I mean, I'm very much worried about the whole surveillance kind of thing. I'm not sure if Trump himself really understands the whole thing. I think he has a lot of advisors who are telling him what to do and what to say, but if he really understood it, I don't know. It probably is the last chance that America can do, because they are not having enough gold.
You know, it's interesting. I read recently that Trump's assets, his corporate and family assets, have shifted from real estate predominantly to now crypto and Bitcoin predominantly.
Of course, it's amazing. I mean, who would have thought that, right? A year ago. To a certain extent, I would say yes. I mean, I think, first of all, the Trump family just wants to make as much money as possible.
Okay.
So that's, I think, the major intent here. And I think it's very questionable what's going on here. Very questionable. But at the same time, of course, I mean, the administration before was also extremely questionable because they were completely against it.
Yeah.
Didn't allow any invention here and progress. So I at least that's what I appreciate now with Trump. But I think it's a turbo casino capitalism kind of style here. And Trump makes sure that his family makes a fortune here. And anything else, I don't know. Is it really better? I mean, yes, they create more demand for US treasuries if people buy more Tether, and then this is getting converted into the crypto market. Yeah, okay, but is this really sustainable? I don't know. I mean, the whole thing is more and more questionable in my opinion. Yeah, exactly. That's what's going on. On the one hand, massive expansion of the money supply, and not only in America, all over the world. If you look at these numbers for the European Union, if you look on Japan, on China, everyone is basically printing money. And on the other hand, the consumers are losing the confidence in these currencies, in these fiat currencies, because they see that they have less and less purchasing power. And so people are trying to escape into hard assets. And that's why, at the end of the day, real estate is still holding up rather well. Okay, there is regional differences, but overall, it's holding up well. And in many areas, actually, real estate is still getting more expensive. Your stock market overall, even though there's lots of questionable things happening in the economy, and you see that basically a stagflationary kind of scenario, the stock market is higher because people buy these stocks as a hard asset, so to speak, moving their money out of the fiat world. And gold, precious metals, mining stocks are moving higher, and crypto as well. And even your rare stamps and your old timers are getting more expensive because the fiat money is losing purchasing power and people losing confidence. I mean, you can see it in many countries. The society is becoming rather unstable. Some of them are actually close to a civil war. These are all the consequences out of it, and this is just continuing. I don't see a turnaround. It basically says that on the one hand, central banks, politicians, increasing the fiat money supply, basically printing money out of thin air, and on the other hand, consumers and participants in these financial systems are losing the confidence because they can see that the purchasing power of their fiat currencies is diminishing by the day in the end of the day. And that's basically happening at the same time. And what it means is your assets or your investments can go up on a nominal basis, while in real terms, they haven't moved at all. But people only look at the value of their assets in nominal terms, meaning in dollar. I mean, how many people are actually looking or calculating their net worth in Bitcoin and in gold ounces? It gives you a totally different picture over a 5 or 10 year time frame than just looking at it in terms of how many US dollars am I in total, or how many euros or Canadian dollars, right? So I'm doing this as a little homework every 4 months, updating a little Excel sheet, tracking my net worth, and you can see how challenging it can be actually to keep up in terms of Bitcoin and gold with your total net worth. You might have more euros or dollars, but not more Bitcoin and gold.
Florian recalls, in 2022, when the Fed hiked rates, Bitcoin crashed, and gold dipped but held much stronger as a safe haven anchor. Since its triple low 3 years ago, gold has risen over 130%, supported by 4 key drivers: expanding global money supply, the bond bear market pushing institutions toward gold, massive central bank buying since sanctions on Russia, and China's relentless gold accumulation for both citizens and reserves. China, already the largest producer, is building vaults abroad to back trade in yuan with gold, challenging the dollar system. This shift is unwinding decades of paper gold price manipulation, as physical demand now drives the market. Beijing is also making gold imports/exports easier. It's seeking feedback on streamlining licensing processes, longer valid licenses, more customs offices authorized, to smooth gold trade. China's consistent accumulation supports the idea that demand from major sovereigns is backing gold's secular bull market. The fact that China is pushing through regulatory/reform steps for gold import licensing underscores a long-term strategy rather than a short-term bet. Central banks globally continue with strong, steady gold purchases in the face of geopolitical risk, inflation, and concerns about US dollar reserve dependency.
First of all, in that 2022, when the Fed started hiking interest rates and everything came under pressure, Bitcoin went down to $15,800 from $69,000, and gold came down to $16,15 from 2070-ish. And had a triple low, more or less 3 years ago. But gold held up much better during that time than everything else. So I remember being very happy having a large chunk of my portfolio in physical gold, because it basically stabilized and was rather a safe haven anchor in that time when everything else was plummeting. So since then, gold is up 130% since that triple low 3 years ago. And you asked for the driver. So in my presentation yesterday in the morning here at the conference, I presented my take on it. I think there's 4 big, very important macro drivers for gold. The first one, I mentioned it before already, M2, money supply, the liquidity basically in the system, constantly being expanded over the last few years, and especially now again in the last few months. And not only in America, but also in the Eurozone, in Japan, in China, wherever you go basically. If you would look at South Africa or Brazil, you would basically see similar numbers. So liquidity expansion. Second big driver is the bear market in bonds, especially in the long-term bonds. So the long end of the bond market, I think the Fed has lost control over it already. We have still a rather persistent inflation. And if you're an institutional investor and you have to seek safe, conservative long-term bonds, and now you're in a bear market in bonds, it's very challenging. So I assume more and more institutional money will go into gold because it's the only other asset that they can buy. So that's the second driver. The third driver is central bank buying. We haven't seen that in like decades, that strong demand from central banks. Of course, it increased dramatically since Russia invaded Ukraine, when the whole world realized, like, whoa, the Americans, NATO, the Europeans just can confiscate our assets whenever, however they want. So now lots of emerging market central banks and nations are trying to diversify themselves out of the dollar, out of the euro, de-dollarization. Central banks are buying gold. They don't chase gold, but they also don't really care about $100, $200. So that's exactly what we've seen over the last 14 months. Whenever there was a consolidation in gold, you didn't really have a big pullback because very quickly physical demand showed up in the market again. And the last one, which is also very important, probably the most important besides the central banks, is China. China is buying gold like crazy. The people in China are buying gold. They love gold. And the central bank is also buying gold on a consistent monthly basis, basically. China is the largest gold producer already, and they consistently buy more gold. They use this, of course, as a way also to attack America, because gold is the antidote to the American fiat dollar money system. And they plan to build gold vaults in many other countries. Yeah. So if they do their trade business with Saudi Arabia and they buy the oil from the Saudis, they will give them the renminbi, and the Saudis can take these renminbis, go in their own country, go to the vault, here's the paper renminbi, show me the gold. And I mean, this is what the Chinese are working on, to inject confidence into their yuan kind of system, building an alternative system to the US dollar system. And that's not going away. Those four drivers that I just mentioned, I mean, they're going to be around for the next 1, 2, 3 years at least. It could maybe take a decade or even longer until this fully plays out. And I think during that time, gold will be strongly supported. There will be strong physical demand. And out of the consequences also out of those four drivers is that you are seeing now the unwinding of that 50-plus decade Anglo-Saxon paper gold Ponzi scheme kind of system, right? Yeah. So we know that in the past five decades, the price making or the price finding for gold has been dominated by trading 200 paper ounces of gold for 1 real ounce of gold. That's how mainly the price finding has basically happened. And this is being unwinded now. And this can take a long time. And again, I just mentioned it before, gold is super strong, no real pullbacks here, no dips, people chasing, running behind the train. It just pushes higher, and whenever there is a dip, immediately big hands showing up with physical demand. And I think it's super bullish. Gold is clearly in a secular bull market. I think the price targets that you and I were talking about 5 years, around $9,000, if you remember. Yeah. I think that's still the case. We probably have to revise them, and it's probably gonna go even higher. The only caveat would be if we see gold now really accelerating dramatically over the next few months and maybe 1, 2 years, doubling in price immediately and running to maybe 8,000, 9,000 in the next 1 or 2 years, then it would probably have the characteristics of more of a bubble, and we would have to be careful. But if it's just pushing higher like it's been doing now the last 14 months, I think it's very healthy, it's very sustainable, and we're going to see much higher prices. And this can last for at least a few more years, at least.
Could China's gold-backed trade strategy accelerate the decline of dollar dominance in global finance? How might central bank gold buying continue to influence prices compared to private or retail demand? If you enjoyed the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, thank you for being with us, and wait for the next updates.
Japanese yen is one of the worst performing currencies versus gold, which in my book is inflation. I mean, not that gold isn't breaking out already, but I think silver will accelerate. And like Phil said, for people who haven't bought gold, I guess silver will be the alternative.
For a person, yes, you always want to go seek out as much gold as possible. When a system has a lot of gold revolving around it, you only get two things. You get more jewelry and you get higher prices. So if China reveals they have 30,000 tons of gold, like that, like we think they might, then that means prices in China in gold terms are going to be sky high, and prices everywhere else are going to drop like a rock.
25th of September, the consultation period over whether silver should be a strategic mineral in the United States will finish. They'll have to start building a silver stockpile. And we don't know how big that stockpile will be. Obviously, in the past, it was 2.1 billion ton. If there's a disruption in the supply from Mexico, which is where they're getting most of their silver from.
One of the worst currencies in relation to gold has been the Japanese yen, underscoring the growing pressures of inflation. Silver is predicted to rise quickly as a substitute for gold for those who missed it, even if gold is already starting to break out. By September 25th, the United States must decide whether to designate silver as a strategic resource. The government would have to accumulate 2.1 billion ounces, which is almost 3 years' worth of mine supplies, if it were authorized. Since Mexico supplies a large portion of America's silver, any disruption there might have a significant effect on the U.S. sector. Experts estimate that there is a 4% chance of such a situation. Mario Ineco, a famous market strategist, and Phil Lowe, a sharp macroeconomic commentator, both highlight that since April, the Dow-to-gold ratio has fallen precipitously, and it currently exhibits trends reminiscent of those seen in 2007 before the financial catastrophe. Long-term charts indicate otherwise, despite some people's concerns that a liquidity event may put pressure on gold and miners. It's evident that the trend is strong because banks like Goldman Sachs are now predicting that gold will reach $4,000 by mid-2026, while silver targets are already almost reached. The wider breakthrough indicates that gold's bull market is well established, even in the face of possible short-term pullbacks. As we dive into the video, remember to subscribe and tap the bell icon so you never miss an update. We value your thoughts, so drop a comment below and give us a thumbs up if you enjoyed the content.
This one here is the Dow gold ratio, and we dropped quite a bit in April when we had that beginning of April, and then it's being consolidated, and now it's breaking down, and it looks a little similar to this, and this was in '07 before the great financial crisis, but I mean, we'll have to see anyway.
One thing I may add, because we were just discussing Weimar, I do want to stress that Weimar was a very unique situation because the Entente powers were not letting Germany default. They said, you cannot default, you have to give us gold. And that's what stretched Weimar out to 2 years. I want to reassure the viewers, like, I think this will be over in 3 to 6 months once it really gets going. It's going to be brutal. It'll be as brutal as Weimar, but it'll be a lot shorter.
Yeah, but in Weimar, it started taking off. The hyperinflation really picked up in the summer of 1922, and by 1923 it was over. So it was about 18 months. And
I think this will be about 3 months. I think they'll once they start losing control of food prices, I think they'll revalue to gold.
And I thought commodities were going to start a bull market in the early 2020s, only because bonds I thought were going to start a bear market, and I thought hard assets will benefit in relative terms. But we see now that banks like Goldman Sachs, who usually just push paper and derivatives, they're actually telling their clients to diversify into commodities. And they even, I think they said that they expect gold well above 4,000 by mid-2026 if the Fed's independence is damaged. So I thought that was interesting.
Yeah, I see that. Well above 4,000 by mid-2026 in the middle of your page, Mario. I see that.
Yeah, it's here. Yeah, right there.
Their calls just follow the market.
Yeah. The other couple of weeks ago, Bank of America, which is another bullion bank, they said, oh, we're bullish silver. We see silver at $42 by the end of 2026. And I thought, That's not bullish. We're almost at 42 now. So, the bullion banks, I mean, I've been following them since I started following gold in '02. And I mean, now they can't do it anymore because gold is in a massive bull market. But for example, a few years ago, if gold was like 1500, they'd say, "Oh, in the next few years, we expect gold to revert back to 1,000," and like so on and so forth. But now, they're saying they're bullish, but I think they're not bullish enough. And one of the reasons is these couple of charts here, and I'm going to bring them up. First one is a bit more short term, and this line here, we're going to see in the longer term chart. I think it's really important. And it was around 2,700, this line. And that's why I think we saw this pullback, in the retest. And now as well, I mean, we've broken out of this pennant or symmetrical triangle, and it's really taken off. And there's nothing like above here. So that's very bullish. I'm not saying we won't see any corrections, and then this one is the same chart, but really long term. And this is why that 2,700, in my opinion, was so important. And I was waiting for that
Wait,
test.
Mario, can you flip back to the other one so I can see
Yeah.
the difference for a second? Okay, yeah, and then go to the forward. Okay.
So this is from the high in 1980 to the high in 2011. That's where that 2,700, when we're breaking out here, I thought we might see resistance at 2,700. I mean, we didn't initially because it went up quite a bit, and then I'm not sure, it went 2,900 or something, and then it broke back down. I think it was after the Trump won the election. But now, I mean, we're really taking off, and a lot of people don't look at these long-term charts, and this is why I think people are concerned about a liquidity event.
Rafi Farber, known as the Endgame Investor, in an interview with Phil Lowe, Mario Ineco, and Clive Thompson, points out that China is injecting funds into its banking system through what it calls reverse repos, essentially providing liquidity much like Western repos. The government is trying to reflate its struggling economy, which faces weak exports to the US and a collapsing property market where apartments, once the main savings vehicle, are now oversupplied and losing value. This has left many Chinese households cautious about spending. While some argue China could rise as a global power, others believe its fate is tied to the West. If US consumers are broke, Chinese producers suffer too. On top of this, China holds vast US dollar reserves that may lose value, and even its large gold stockpile could backfire by pushing domestic prices higher and undermining exports. In short, both China and the West are trapped in the same fragile global system, and neither has outsmarted the other. Let's revert back to the...
This is the case. I think when China refers to reverse repo, they mean what we would mean by repo. I think they just got their terms.
Yeah, they are buying. I think they're buying the government bonds from the banking system and injecting cash into the banks.
Yeah, so
US is the other
that's
way
what we would
around.
call repo in
Yeah.
China. They
Yeah.
call it reverse repo.
Yeah.
Whatever. It means they're injecting cash into the banking system.
Yeah.
I didn't hear about this. China is they're like on a different wavelength because their interest rates are going down and down and down, and the West interest rates are going up and up and up. I still think that when the West falls, China falls with it because they are the producers and we are the consumers. So if the consumers fall, the producers fall too. Like if you lose your customers, you lose your income. Or if the currency collapses in which you're getting your income, then you lose your income also. Why China would be injecting cash now? I mean, we know. I mean, the place is very opaque. It's still communist, except for the special economic zones that they allow freedom in, so they can supply the West with a bunch of stuff, so they can stack more dollars. But China's economy has been so fake for so long, and they still have these ghost towns and this whole real estate bubble throughout the whole country, and it's still like a very corrupt, disgusting regime. I mean, we're not allowed. We don't really say that because the West gets most of its stuff from China, but that's still the reality, and it's gonna have to go.
Not very different though from our regimes.
That's true. No, I guess in the way it functions, no, but at least, I mean, the West still has an idea of individual liberty, whereas I don't think the Chinese see that as a value at all, other than maybe a temporary expedient. There's still a feeling in the West that individual liberty is a good thing in and of itself. In China, that was never there.
Things, the Chinese injection of funds, or
I mean, they want to reflate the economy. China's suffering obviously from the slowdown in sales to America on the one hand, and secondly, the way of saving traditionally in China has been by buying apartments. So many Chinese people bought apartments, and now suddenly they're finding that the bottom's fallen out of the market because there's far more apartments or houses, if you like, than there are people to occupy it, and the population is not rising anymore. So and a lot of building companies have left these blocks of apartments which they're building and that people have paid for. They're half empty. So suddenly everybody is now drawing in their horns saying, oh my God, my traditional form of saving isn't working, and they're not willing to spend money on things. And so the Chinese government definitely has to reflate the economy. I think we're going to see more of that. I think that's just a first step, and we'll probably see more money thrown at the economy sooner or later.
Oh, yeah, there's a lot of people who think that China is somehow eating our lunch, that they've somehow outsmarted us, that, and I think your friend King Kong, Eric Young, is talking about the rest of the century is going to be the Chinese century where China is going to move to the forefront.
yeah,
I don't
think
think
Jim
that's true
Rogers
at
said
all.
that too, didn't he? Jim Rogers, I think, yeah.
Yeah, I don't think that's true at all. I think we're going to see. I mean, we're all going to go down together. It's not like it's not like we're going to do fine and they're going to collapse. They are holding enormous amounts of American dollars. We took all their stuff and we gave them dollars, which we're going to default on, and so all the people holding dollars are going to be completely broke over there. Not to mention they have overbuilt their industry, and maybe some people say, well, it's better to be overbuilt than underbuilt, but they're going to have a bunch of factories with absolutely no one to sell to because we are broke. America's broke, so we can't buy any more Chinese stuff, and there's not going to be anything in China to sell. There's not going to be anyone to buy. They can maybe sell domestically to their gold holders, and gold and silver holders, but most of the Chinese are also broke because they bought, instead of going to gold, they bought a bunch of real estate. So to say that if you think the Communist Party of China is somehow doing better than us, then we should not have a free society. Then communism works, right? If you think communism works, if you think China's beating us, then that means communism works, and maybe we enjoy our personal liberties better, but communism is now a better state. And
Well, I didn't say that.
Yeah.
I'm just.
I know you didn't. There are Chinese.
I'm
Chinese
just reporting on the injection of funds. But
yeah, absolutely.
I think China though has a lot more gold than they tell us publicly. They've got a lot more than 2.3 thousand tons.
That's also not that's not necessarily a good thing, because gold has, having lots of gold in a system. I'm not talking about a person, because people mistake what I'm trying to say. For a person, yes, you always want to go seek out as much gold as possible. When a system has a lot of gold revolving around it, you only get two things. You get more jewelry and you get higher prices. So if China reveals they have 30,000 tons of gold, like we think they might, then that means prices in China in gold terms are going to be sky high, and prices everywhere else are going to drop like a rock, because we will want to sell them stuff to get their gold. Now, what's that going to do to Chinese industry? It's going to collapse it. Chinese export-based industry, when prices are sky high in China. So they have all kinds of problems on their end too. It's not like they are not outsmarting us. They're not outsmarting the system. The system is stealing from everybody around the entire world. And we Americans are sitting in drowning in debt. And in China, they're slaving away for American debt that's not worth anything. So they're slaving away for nothing.
Both the U.S. and China face mounting economic pressures. Whether it's America's debt-driven push toward hard assets like gold and silver, or China's struggle to sustain growth amid a real estate bust and reliance on weakening U.S. demand. Precious metals are increasingly seen as safe havens in this fragile global system, and their rising momentum underscores a deeper shift away from trust in paper assets. Could silver's potential designation as a strategic resource accelerate its price far beyond current projections? If China reveals its true gold reserves, would that stabilize its economy or trigger more volatility worldwide? Feel free to share your feedback in the comments below. If you found this helpful video, hit the thumbs up and subscribe to keep up with our latest updates. We appreciate you being a part of this journey.